You can complete a 1031 exchange and still owe taxes, but most people do not find out until it's too late. In this video, we're going over Boot, what it is, how it gets triggered, and how to structure your client's exchange to avoid an unexpected tax bill at the end. I'm Ryan Stulman, president of US 1031 Exchange Services. We've been helping investors and their agents navigate 1031 exchanges for over 35 years. This channel is here to make the 1031 process clear and straightforward, so your clients can defer taxes and keep more of their equity working for them. Boot is anything received in a 1031 exchange that is not like-kind property. There are two main types. Cash boot is any cash your client walks away with from the exchange, money that didn't get reinvested into the replacement property. Mortgage boot, also called debt relief, happens when the debt on the replacement property is less than the debt on the property that was sold. Both are taxable, and both can show up even when your client thinks they did everything right. Here's how boot gets triggered, and it happens more often than you think. The first way is trading down in value. If your client sells for $1 million and buys a replacement property for $900,000, that $100,000 difference is boot, and it's taxable. The second way is not reinvesting all the net proceeds. If the exchange generates $500,000 in net proceeds and your client only reinvested $450,000, that leftover $50,000 is cash boot. The third way is not replacing the debt. If your client had a $400,000 mortgage on the property they sold and only takes a $300,000 mortgage on the replacement property, that $100,000 reduction in debt is mortgage boot, unless it's offset by additional cash reinvested into the deal. By the way, if you're an investor yourself or a realtor who works with investors, click on the link in the description to start your 1031 exchange today. The golden rule of avoiding boot is simple. Reinvest all the proceeds and replace the value of your debt. There are three strategies that make this happen. Reinvest all net proceeds. Don't pull any cash. Third, replace the debt, either by taking on a new mortgage of equal or greater value, or by adding cash to make up the difference. Hit all three and your client walks away with a fully tax-deferred exchange. Now, boot isn't always a mistake. Sometimes it's intentional. If your client wants partial liquidity from the sale, they can structure the exchange to receive some cash, pay tax on that portion, and defer the rest. It's a legitimate strategy when the client understands the trade-off and makes the decision deliberately. The problem is when boot happens by accident. There's no one caught the value gap or the debt mismatch before closing. This is where realtors add real value. You're in the room when the numbers are being worked out. You can spot a value gap before it becomes a tax bill. You can help your client align the purchase price and financing structure so the exchange works the way it's supposed to. And you can educate them early, before they've already made a decision that triggers boot when they weren't expecting. If you want to understand how the exchange timeline works and what your client needs to have in place before closing day, watch this video next.